Well, my name is Elliot Harris, and I'm the chair of UK Business Advisors Financial Solutions Group. And I'm here today with my colleague, Richard Olsen. And Richard's going to be talking to us about funding sources for your business mergers and acquisitions, and covering some of the things that you need to consider when you're looking to fund the potential growth of your business. So, Richard, over to you.
Thank you, Elliot. Okay, so as Elliot said, I'm going to talk about mergers and acquisitions. So if I go through what we're looking at. So generally, the types of solutions we focus on are business-to-business trading businesses, and the funding solutions are all built around what's called asset-based lending. So that's securing lending against plant and machinery, property, sales ledger, i.e. your debtors, and supporting it with some sort of working capital loan, and a mixture of client funds and or other sources of funding as well. Now, when we talk about plant and machinery, we're generally talking about manufacturing or engineering environment. We should be able to get a sale and leaseback on any equipment which has little or no debt on it, and obtain that at around about 80% of the actual equipment value. Property is also another very interesting opportunity. You can get up to 70% of the value of the property. This is obviously valued by the lender. Rates with the high street are very competitive and will be around about 3% per annum over base. And then the final piece is sales ledger or debtors. Invoice discounting is a solution which, when you're looking at a manufacturing business, you would typically up to 85% of the value of those invoices within, say, a 90-day debtor period. For a recruitment business, that can go up to as much as 90%. And for other businesses, say in the construction sector, you might find that's as low as 55%. So in essence, if you have a debtor book of £1 million, for a construction company, that might only be worth £550,000 towards the cost of acquisition. For a recruitment company, it might be worth as much as £900,000 towards the cost of acquisition. Working capital loans, generally, they're built to match the funds that clients are actually putting into the deal themselves. So we're seeing a lot of cases where clients are trying to go in with no money down deals. So that's obviously not a solution generally available to those businesses. Those businesses and their acquisition targets may be taking on CBILS loans, for example, to generate additional cash within the business. And that's another source of funding for your acquisition, is to actually look at cash within the business and actually utilize that as part of the funding deal. But at the end of the day, you need to ensure you have enough working capital left to actually repay all this borrowing that you're actually going to push into the business. And then one thing we would recommend that most directors will obtain is a personal guarantee insurance on the actual loans that they're taking out. As we know, with assets like plant and machinery and property, they are secured against the property or the plant and machinery. With an aged debtor book, they're typically secured against the debtor book itself. There's generally a requirement for a personal guarantee to support that in the event of there being a failure of the business. And it's always worth looking at that. Other sources potentially of funding might be equity investments, so getting external business angels to come in and invest alongside you. Right, if I move on a slide, the important parts that you need to understand when you go to market are, first of all, you need to know who to approach. You need to understand the difference between a B2B and a B2C solution. Generally, if we look back at the previous slide, in the B2C world, most, let's call it retailers for the want of a better description, don't own property, don't have plant and machinery. They are limited to just debtors, and those debtors are invariably individuals. Now, lenders do not wish to give invoice discounting against individuals because it has reputational risk attached to it. In the event of you failing as a business, they're not going to chase after Mr. and Mrs. Jones down the street for their £4.40 worth of debt. They're not interested in that type of loan. So it automatically cuts down the amount of routes available to you. So as I said, we're primarily focusing on B2B. We have to know the tricks that funders get up to, because we have to know the right questions to ask. And it's quite important to put funders into competition with each other. Whilst in an acquisition environment, it's very difficult to get as many lenders offering you terms, it's still possible to put them into competition with each other. But a really important part of this process is producing the pack of information to support your acquisition. Now, this will include background CVs of the directors, financial forecasts for the business, how you're going to change the business going forward, what happens when Mr. and Mrs. Owner retire from the business and you fully take it over, what's the succession planning. And these are just a number of different areas that we can assist with in terms of putting together the right information. And final point is really that high street banks will always be the cheapest, usually. There are some caveats to that. And generally you find that with banks, you're able to negotiate a little bit more in terms of personal guarantees and other bits and pieces, as opposed to potentially peer-to-peer lenders who would require 100% personal guarantee in any form of loan.
Yeah, Richard, you mentioned the different types of funding. Invoice discounting was one. Factoring is another, but factoring historically tended to have a bit of a sort of bad name. I mean, is that still the case?
I think it's historical, and I think that's much an age attitude more than anything else. I think in years gone by, it was just assumed if you used a factoring company, that meant you were in some sort of financial difficulty, when actually the opposite could often be true, that actually you were in a great period of growth, and actually you were using factoring to help fund your growth. And since the advent of factoring, we've moved on to invoice discounting, confidential invoice discounting, confidential factoring, which chocks. There's lots of different solutions here. It's no longer disclosed as readily as it once was. In some instances, on different funders, it depends on the client and whether it's important to the client to keep it confidential or not. So I don't believe there is really an issue with invoice discounting and factoring anymore. I think it's more down to the individual concerned.
And obviously we've been going through difficult times over the last year, and there's been these different pieces of finance from the government, CBILS, loans, and so on. Mm-hmm. How accessible is funding at the moment? I mean, is it still difficult to get money, or does it depend?
No, I think what we're finding now is the market is starting to return to normal, and I'd say start. There has been plenty of activity by alternative lenders throughout this period of CBILS and bounce back loans, and I think the real difference is now we see CBILS coming to an end. There may be possible extension again, but realistically, let's say it comes to an end shortly, then the market has to return to some sense of normality. However, the market's going to be asking lots of questions about CBILS, how the COVID pandemic has impacted the business, what bounce back loans are sitting there, what's sitting there on the balance sheet that they can't see there today. So the information will be focused primarily around bank statements for the last 12 months, up-to-date management information. Those are going to be key bits of information. And as anybody acquiring a business, they're probably more important than ever before. I think it's too easy to recommend to your target company to go and get, for example, a CBILS loan without thinking about the consequence of actually that's a liability sitting on your balance sheet. It might be great that you've got more cash in that business to help fund the acquisition, but you've also got a longer term liability that you actually have to repay.
Thanks, Richard. I know we're going to be talking in a couple more videos, one on cash flow and working capital and one on personal guarantee insurance. But thank you very much for talking to us about mergers and acquisitions and the solutions that are available. Thank you.
Thanks.